My own connection to the FMA arises from three simple things. The association is the largest interface between the scientific research enterprise and those engaged in that enterprise. It has the broadest intersection. The FMA addresses the quality of teaching and innovation in teaching. And third, and most pertinent for today's event, the FMA brings together theory and practice. That brings me to the particular celebration of achievement and excellence today. Ms. Cunningham has asked me not to read her bio. So I'm in a bit of a tough spot, but I'm going to say that she has significant and interesting and material span of control as the president of the NYSE Group. Right? She's got the New York Stock Exchange, a diverse array of equity and options exchanges. And I think it's also noteworthy that the exchange was founded in 1792, and we're 228 years old. The FMA is nascent, and she is the first woman to lead the NYSE Group. She's got a background as COO. She has served as president of governance services for NYSE, head of sales and relationship management at NYSE. She's been a Nasdaq. She started her career at the NYSE trading floor, where she was a specialist. And she's got, Kathleen Weiss-Hanley would insist that I mention that Stacey has a BS in industrial engineering from Lehigh. So first things first, given our orientation towards practice, the intersection of practice and scholarship, we're especially grateful for your presence here today, Stacey. Second, there are a lot of interesting material things happening in your business. And for any discussion topic, I realize that your overarching views and guiding principles, as well as the evolution of the group, its current structure, its past structure, its technology, those things pertain to the issues. So please feel unrestricted in responding in broad or narrow terms or in both. I do plan to start by asking you about Pillar, but I'm wondering if there are any sort of introductory comments that you would like to offer, composition of the group, your overarching principles as they apply to markets and their function.
Sure, thanks, Jeff, and big thank you to you and to Rena and to FMA and the entire team who's pulled this event together. I really appreciate your having me here and all the work that you do each and every year. It's one of my favorite events to come to. 2020 has certainly been interesting, would be an understatement to call it that. It's been a strange year on a number of fronts and full of twists and turns and surprises, very challenging in so many ways for so many businesses. One theme I think is important to not get lost in all of the hardships of 2020 is the good news too. And for this group, I think it's in particular relevant to highlight the good work that our financial markets provide. And so as our entire global economy has been challenged and people have been challenged, and it's hard enough when people are worried about their financial safety, but also worried about their personal safety at the same time. Either one of those things can be challenging and concerning and cause stress. And in 2020, so many people have had to worry about both their financial stability and their physical safety. And so that's been an underlying theme that I think has been challenging. But businesses have been part of the solution. And what we saw from my vantage point in March, when the pandemic really hit, along the 2,200 listed companies that make up the NYSE listed company community, they all dove in and looked for challenges and solutions to the problems. And when we think about the value that our capital markets provides to society, we often forget that big businesses are, they can get painted in a negative light, but the value that they provided to creating vaccines and therapeutics and really tackling this pandemic, putting aside in many cases what their own quarterly targets or business plans were, and really focusing on the stakeholders around them and their communities to be part of a solution, I think was very inspiring for me to see. And so I think we shouldn't lose sight of the value of what the financial markets can support.
So the umbrella, in that context, I think the umbrella for a set of questions I'd like to ask include competition in your own markets and how you've responded and how you serve those companies that you've you've just described and how they've stepped up. And I think maybe Pillar is part of that, and kind of how you can advantage your members. Would you please tell us a little bit about Pillar and what it is and the benefits and costs, and about implementation, and if you
Sure, absolutely. So NYSE Pillar is the technology platform that we rolled out across our equity markets, and we're rolling out across our option markets in this coming year. What it really does is provide best-in-class technology that means it behaves exactly the same way under all market conditions. So when markets get really, really busy, it doesn't slow down. And that's important for market makers, because as we know, the markets in the US have really evolved pretty dramatically, and we're much more dependent on market makers setting prices for companies as they trade each and every day. And that's a very sophisticated risk management exercise. So they can make better prices when you limit the risk and you take out some of the uncertainty in the market. One element of risk is how quickly they will be able to update those prices in very quickly moving markets. So when volatility is really high, that risk profile can change if technology systems slow down. So we designed Pillar to be a scalable system that would behave the same way under all market conditions, so that market makers know that as they're setting their prices, they're going to be able to update them and limit that risk, which ends up putting more money back in investors' pockets, because retail investors and institutional investors will get better prices if the displayed markets are showing better prices. So that's a significant undertaking, because you have no idea how quickly markets will scale. For an example of that, our peak message day prior to 2020 was 110 billion messages that our systems processed in a single day. In March of 2020, that went to 330 billion messages. Compare that to the single digit billion Google searches that occur across the world in a single day. It's a lot of data, it's a lot of processing. So to be able to do 3 times your prior peak with no issue is really important. The other aspect of that technology platform is, or just technology platforms and exchanges in general, is you don't get to test them. You test them in simulated environments, but you don't get to test that real strain until the major market event happens. Same with any protections we put in place as an industry to enhance resiliency in the market. You don't really get to test them in a live environment until the next major market event. So you study them, you figure out what you've learned, how can we improve the market resiliency, things like market-wide circuit breakers and others, but then you don't really get to see it live until the next event. So a lot of the changes that we've put in place over the past few years as an industry, we were all tested in March. I mean, literally everything in the toolbox was thrown at the March volatility, and including BCP plans where everyone was operating remotely. And that's something that, again, we've never had to use live. It's been tested. Operating the New York Stock Exchange without a trading floor has been tested, but it hadn't been used live. So literally every single thing was used, and the industry should be incredibly proud of the resiliency, operational resiliency of how the markets continued to function in a way that they were designed to function in light of 4 market-wide circuit breakers and the like. There's some lessons learned in there, I think, as an industry, as there always are, and we'll continue to look for changes to put in place that continue to build on that. And I think there are some there's some of the aspects of market structure contribute to the volatility that we saw in March. And so I think that's another area that's worth exploring, because we talk a lot about fragmentation in markets, and I think that contributes a lot to how rapidly markets move when volatility picks up. And so I do think that's something we should address as an industry going forward.
So have you seen discernible changes over this short period of time that you're talking about here, and trying this out and beta testing it for real?
Yeah.
Have you seen discernible changes in price discovery and kind of the market microstructure?
Yeah, absolutely.
Are you able to talk about that? Okay.
What you see when volatility picks up is you see a lot of the trading that typically occurs off of exchanges and in dark pools or ATSs. You see a lot of that volume migrate back to the exchanges during really volatile periods of time, because again, the risk profile changes. So if you're trading against order flow in a dark pool, and those prices are changing very quickly, the displayed quote is changing quickly, your risk profile is different. So you're more likely to send those orders to an exchange for execution instead of trading against them yourselves. So many of the brokers choose to do that. And so that's a shift. You see more flow come back to the exchanges. You also see an increase in trading in ETFs, because ETFs provide a way to very quickly exhibit a thesis on investment. You can focus on an asset class or currency very, very quickly. And so you see that happen as well. The percentage of the market trading that is focused on ETFs is much more significant during volatile periods. The other thing we've seen specifically during this year was a rise of retail trading. So significantly more retail traders were part of the volume throughout the second and third quarter. And I think there are a few drivers to that, not just the market events, but also many of the retail platforms went to free commissions over the past couple of years, and people were home. So as people were locked up at home with not much else to do, and there weren't other outlets for speculation, the market certainly attracted a lot more retail investment. So we've seen the number of retail traders increase dramatically in 2020. All of those things sort of came together and also contributed a little bit to the volatility that we saw in the market. So I think it's important to recognize how important it is to set those prices and have them displayed to the market. One of the things we've talked about, and I've talked about at Georgetown for many years, is our concerns with the transaction fee pilot, and the fact that it was going to take away incentives that exchanges are able to use to promote displayed prices. And one of our points that we've been making is it's less relevant in low volatility environments, but certainly more significant when markets start moving very quickly. And I cannot tell you how glad I was to see that pilot did not go live in March and was not, we still had the tool to be able to promote displayed markets during very volatile markets, and that we didn't have companies in different buckets that were going to be experiencing different behavior during such unprecedented volatility.
So you've touched a little on this. Have there been discernible changes in liquidity and price impact of trades? I mean, you're talking about changing composition of trades, and I mean, can you talk about that?
Spreads tend to widen a little bit when markets are more volatile, so you definitely see that. In fact, there are a number of studies. There were some academics and brokers as well that studied the period of time, even just when the trading floor was closed, because it was the first time in our 228-year history that we closed the trading floor but kept our markets open and operating fully electronically. So while the floor has been closed during other major events in the past, the markets were closed at the same time. This is the first time the New York Stock Exchange was up and running and fully trading all of our stocks, but didn't have the trading floor there. It's not something I would have chosen to run, an experiment I would have chosen to run just so I can study it, but we certainly did study it given the opportunity, as did some others. And what we saw was that there was price degradation when the trading floor was closed. And it was hard for us to understand, without having that visibility, how much of our outperformance comes from the fact that we have a market model with market makers who are responsible for having the best markets in a certain percentage of the time and layering interest and opening closing stocks. Like, they have accountability, which is unique to the NYSE markets. And two, we also have that human judgment layered on top of that. We've never really thought about them as two separate things because they've never been separated until March 20th when we broke them apart and said we still have the accountability. Our designated market makers still had the same obligations, even though the trading floor was closed. They just met them fully algorithmically. On the flip side, the people weren't on the floor. So we didn't have the benefit of the trading floor community and the human DMM applying human judgment. And so what we saw was our outperformance actually comes from both. So our stocks still traded better than a fully electronic market, other fully electronic markets without our accountable market maker, but not as well as the NYSE did when it does have our full floor open and available. So it was an interesting data set to see. It's what we found when we studied the data, but then academics and RBC also did a study looking at particularly the closing auction had deteriorated when the floor was closed, smaller auction size, smaller liquidity. So it did have an impact on prices. To your point, certainly then, but generally when volatility picks up in the market, spreads widen out. So
I'm using sort of the migration pillar to the other platforms to frame the question. So you've talked about how you've learned a number of things over the last few months. And I'm curious, are there a couple of those that you would highlight? And could you talk about the extent to which those things that you've learned are going to enable your migration to the other platforms, the other exchanges, to the options?
So I would distinguish between what we've learned from Pillar and what we learned from just market events, because Pillar performed extraordinarily well during all of this, all of the events of this year. And so we were very, very pleased to see how well it performed with market-wide circuit breakers and in light of everything. There are some lessons learned on Pillar when we first started the migration with our first market a few years ago. And we've certainly invested heavily in running full simulations of testing without having markets open at full scale and replicating, a lot of the issues that we found when we first were moving our technology over is there small edge cases. When you're processing 110 billion messages, you sometimes there is a series of events that is so hard to replicate because it matters how quotes change at what time on different markets that we're routing out to. Our equity markets are pretty complex. And so replicating each of those in QA testing was one of the challenges we were trying to overcome. So what we learned is if we actually just run months of production data through our systems, and test it that way, it allows us to really shore up our testing practices in advance. And so that's been a great tool for us as we migrated additional markets. And the New York Stock Exchange is the largest market in the world. And we rolled that, technology out there. I'll tell you, you get a little anxious no matter how well things have performed in testing when you're changing the tires on a race car as it's going around the track. So, there's a comfort level. The industry tests market-wide circuit breakers. The first time we triggered it this year, everyone's taking a deep breath and just making sure everything goes as well as possible. So, that all worked very, very well this year. Lessons learned, I think, were more around the circuit breakers and how they triggered when the markets are down dramatically overnight, more than 7%, or futures are in a limit state, and we open the markets at 9:30 only to trigger a market-wide circuit breaker seconds later. Perhaps there are ways that we can continue to build on that. So work is underway to modernize some of the elements of that. I'll tell you a funny story just from 2020 is I received a call from former Secretary of Treasury, Nick Brady, who was the father of the market-wide circuit breaker. And he wanted to assure me that I was right in not closing the markets entirely. Because back in March, I don't know if you remember this, but there was in light of the dramatic sell-offs, there were a lot of people asking for a broad market closure. Like, let's just take a breather. Let's shut down for a couple of days and let the markets, quiet down. And I was very adamantly opposed, as were many others during that period of time, because it's important that people had access to their money, especially during times of stress. And if they thought that there was the possibility of a market closure, that on its own could put additional selling pressure. And that's what Secretary Brady was recounting from the 80s, that actually happened. As soon as somebody had said, yeah, anything's on the table, there was a major market sell-off because people were feared they might lose access to their money. And closing the markets wasn't going to change the underlying conditions or solve for the pandemic. So we opposed that one pretty strongly. But he gave me a call to say, this is why we designed market-wide circuit breakers for events like this, so we can pause the markets, and we'll continue to iterate on them as we have in the past.
So I was going to ask this a little bit later, but it must, on the technology side, some of the events that we've observed at exchanges give you some pause, I would say, and I'm thinking in particular the JPX Tokyo Stock Exchange outage. Can you provide a perspective on that, would you, and tell us kind of how that sort of episode filters back into your thinking and what you do at NYSE?
Yeah, I mean, episodes like that are always top of mind in our thinking, not just when another exchange has an issue, but we recognize the importance of our markets being operational and being functional. And so we focus on that every single day, and it runs through our DNA. We're not without our own issues, right? I mean, all exchanges have found themselves in that uncomfortable position of having something very publicly go wrong. And it's a terrible position to be in when you're leading an exchange, and it's a terrible position to be in at another exchange and you're watching an exchange go through that, because at the end of the day, investor confidence is really critical. And so making investors feel comfortable in the fact that exchanges will operate the way they're supposed to is a big part of our job. So we spend a lot of time on testing. We spend a lot of time on checking resiliency, setting aside even all of the cyber concerns, everything around changes you make yourselves, and there are a lot of elements to updating systems so that they can keep up with increasing volumes, adding new features so that they can meet client needs, adding new features that meet changing regulatory needs. There are a lot of changes that are going on throughout the markets. And so that's really, really top of mind for us. And I recall testing market-wide circuit breakers a couple of years ago, and one of the Saturday tests didn't go that well. And I remember having a really stern conversation with our team saying, if we ever need this live, it actually needs to work perfectly. So we need to make sure, things are already bad if you're using a market-wide circuit breaker. So we put a lot of energy into making sure our testing is flawless, because that's how production is going to be. We need to make sure production is flawless. So I don't think you can lead a major exchange without putting that level of focus on having perfection in production.
Yeah, so that's kind of that's a list of sort of lessons from the Tokyo Stock Exchange episode and maybe other similar episodes. So Stacey, you're talking a little bit about innovation and changes and the changing landscape. And the NYSE has worked with issuers and regulators and the global markets community to create NYSE direct listing.
Yeah.
And I'm wondering if you would kind of describe the background of that and maybe say a little more about the costs and benefits and compare it to being private or IPO or going
Yes.
to IPO or however you might do it, and talk about the uptake, maybe Spotify and Palantir and some of those.
Yeah, there's a really interesting evolution happening in the public markets. And it's driven by the fact that companies have choices in different ways than they did historically. So when a company was private and needed to raise money, the public markets was its obvious choice. And that was the primary driver for companies to go public, was to raise capital. And then secondary and tertiary reasons were things like having liquidity for their investors or their employees, or having currency so they can engage in M&A, or having the credibility and visibility of a public listing as they're trying to attract new customers in many cases. And so, or even employees as they're trying to recruit talent, that was a big part of it as well. Those were secondary, tertiary reasons. Now there's so much capital available in the private markets that companies aren't going public purely to raise money. They're going public for those other reasons, which have now become their primary reasons. That means they can think about how they go public. And so it started with Barry McCarthy, who's the CFO of Spotify, called us at the end of 2016 and said, well, I want to go public, but I'm not doing it to raise money. So why do I need to do an IPO? And his frustration was not about banks earning fees on his public offering. It was about the cost of capital. So if he's selling shares and those shares pop 80% the next day and people say, wow, it was a great IPO, it's up 80%. Well, it wasn't great if you're the one that sold it the night before. That was his view, is why should I hand that money away to others for 12 hours of very little work? And if you think about the evolution of the IPO and how we got here, because companies were going public earlier in their life cycle and they were smaller and they were less tested and less known, banks were going out to their customers and asking them to take a risk on this company, going on the roadshow, explaining what the company does, but saying, yeah, there'll be some benefit to you as it goes public. We're going to sell it to you in an allocation, and then you'll see some level of first day pop in the market. That risk profile has changed a lot for those investors because the companies are much more mature. They very often have public money invested in the private markets through the likes of, T. Rose and Fidelity and others who are investing in private companies already. So you look at a company like Uber, it's a well-known, mature company that had a lot of public money already invested in it before it was even a public company. So do they deserve that first day pop, just for taking a risk, or has it just become a shift of haves and have-nots? And so that was a real question for Barry. We went to the SEC and we started working through the details with Spotify on a direct listing and helped really design what that could look like. It took a year and a half, but he was patient and was willing to wait to go through the SEC process to get it done. So they were the first one. And then Slack followed suit a year later. After that, there were a lot of questions around, well, what if I do want to raise money at the same time, and I do want to raise capital, and I do want to be public, but I don't want it to be priced through an allocation to a subset of issuers. I want it to be priced in the market. So we started to work with the SEC on that and filed to introduce a capital raise. There are a number of elements that are really unique about a direct listing. Things like, it's a much more democratized way to go public. Everybody's on a level playing field at the time of the listing. It opens up in the morning, and we determine, by buyers and sellers, supply and demand, determine the value of that company. And there you take away a lot of the artificial constraints. So during an IPO, the buy side is artificially constrained because people don't get the full allocation that they want. The sell side is artificially constrained because there are a lot of lockups in place and people can't sell freely for 6 to 9 months. So you don't get to that stage of where buyers and sellers are actually setting the price of the company until, at least 6 months after the listing. So with the direct listing, you got there much more quickly. And you can see that evidenced by Spotify and Slack were 2 of the largest opening trades in the history of US markets. And they weren't the largest companies, but they were the most shares that traded hands. So it was literally Alibaba, which was the largest IPO of all time, then Facebook, and then Slack as the largest IPOs. Slack traded $1.9 billion worth of stock in that opening trade on a $19 billion company. Really, really big opening trade. That's real price discovery. And so you lose that first day pop, and so now as we work to the capital raise, it'll be another way for companies to come public. So issuers have more choices than they've ever had. We've seen the rise of the SPAC this year as well. And I think that's reflective of the same sentiment. I want to be a public company, but I don't necessarily want to do an IPO. And why should I have that cost of a first day pop, a cost of capital in that offering? And again, this isn't about the banks. They play an active role in all of these ways to go public. And it's not about having them disintermediated. It's about where you're selling your shares and how they get priced. So interesting developments. I mean, we've seen more SPAC proceeds raised this year than before and than ever before. And we've had over 75 SPACs list on the New York Stock Exchange just this year to date.
So I've got some questions from the audience, and I'm going to weave those in. So I want to let you guys know that I'll do my best to do that. But all right, I will do my best Mike Wallace impression here and ask you about there have been some objections to direct listing. I think maybe the Council of Institutional Investors had something to say about it. Can you describe what the objections are and how you think about them?
Well, I'll start with how I think about them. Anytime you're disrupting the status quo, you tend to have some people who oppose it, and so there is that. And I think the louder those objections are, typically more reflective of some interest that might be there. What the Council of Institutional Investors has claimed is that you're reducing shareholder protections if you go public through a direct listing, because there was a lawsuit of a company, and they said, well, we didn't actually offer you shares, so you can't claim that we weren't selling shares, so you can't claim protections under that, which is also true for an IPO. I think the real difference here is that you don't have underwriters, and so there aren't as many deep pockets in a direct listing as there would be in other places. But companies are still going through the same filing process. They're filing an S-1 with the SEC. They are, listing on the exchange, going through our same listing review process. So the disclosures and the transparency of a public company is still there. We did receive approval from the SEC on delegated authority. So the SEC staff approved our filing to introduce a capital raise. CII asked that the full commission review the filing, given some of the concerns they have around shareholder protections. And so the full commission will review it. We don't have a timeline on that, but I'm optimistic and hopeful that it'll happen pretty quickly, because there are a number of companies who are looking at that as an alternative to an IPO. Let me explain why. Snowflake, largest software IPO ever, went public on the NYSE a couple of weeks ago, raised $3.5 billion, and the next morning popped another $4 billion. So that seems like an awful lot of money to put in the pockets of somebody for 12 hours of sleeping. There isn't a whole lot of work that was done there. And that's the problem we're trying to solve for here is how do we give issuers and their investors a more democratized way to the public markets? And I think we need to remove some of the barriers for companies going public. It's really important that we not lose sight of the fact that our capital markets are so great and so wonderful and have been such a powerful force in this country because it's about shared success. And when companies are public, anybody else can invest in their success and dream alongside them and plan for their futures and plan for their family's retirement and everything. If companies are staying private, it's not shared success. And so you really start to contribute to that bifurcation of wealth that we see. And we want to make sure that we're giving companies reasons to go public and not looking for other reasons to avoid it if they're better off raising money privately.
Yeah, I have the sense that you're speaking very directly to the margin at which you decide to list or not list. And those of us who are on investment committees are very sensitive to that because we're trying to allocate our portfolio, and so we have kind of high friction, high cost access to private equity or lower cost access to listed firms. And I think that's in part what you're saying.
Yes, I mean, I absolutely think so. And there's a lot of talk about opening up the private markets to have more, better access there for a broader group. But if we're going to introduce retail investors or broader investment into the private markets, and we don't feel the protections and the transparency of the public markets are so critical, why wouldn't we just address some of those things in the public markets? But the fact of the matter is that discipline, that governance, and that transparency of the public markets is what leads us to more accurate valuations of companies. We talk a lot about why companies stay private and what the challenges are. We don't talk as much about what the downside is. And so they don't have valuations that are based on transparent information that's widely consumed and buyers and sellers coming together. They don't have the discipline and governance that public companies have. And they are contributing to that wealth divide. So I think those are all really important issues that we need to address. And it's not just because I run the New York Stock Exchange. I mean, we certainly could build out our footprint in the private markets. I think we're better off putting a lot of energy into innovations in the public markets so that we are doing the right thing for the country.
Yeah, it is. A yearly appraisal is a little different than a microsecond valuation stream. So I've got, I want to move on to MEMEX in just a minute, but I do have one question about whether the high-speed technologies and markets, have they evolved so much that they need different varieties of speed bumps in regular trading as opposed to just circuit breakers? So that kind of gets back to our prior discussion.
Yeah, I mean, I think a lot of the speed bumps and things like that are at another level of complexity to our markets. They cause a little bit more confusion, I think, at times. There is some demand for products like that, given the way markets have evolved. I think more important than high-speed markets is consistent markets, like operating the same way. And that's what I was talking about. Our focus for Pillar, while we are, among the fastest exchanges out there, where we really differentiate ourselves is we are the most deterministic, which means we are the most consistent in our performance, because that's where you're getting real value. I think on the high, how quickly we can stop the arms race, right? I mean, I don't think we need to necessarily make markets faster. And you're seeing a lot of interest in new market structures that also lead to further fragmentation. So I do think we want to simplify our markets because that leads to less risk, higher degree of investor confidence. I think that we would be better off focusing on things that do that and frankly, reducing fragmentation. I know I say that operating 5 equity exchanges, we'd be happy to reduce the number of equity exchanges we operate. There's some dynamics in the market that really lead people to making decisions that I think we could do better on.
So I'll disclose the originator of the question. It's Amy Edwards at the US SEC. And she writes, you discussed outages earlier. Does regulation SCI make a difference in outages or the other issues it covers, or does the market have sufficient incentives to avoid such issues?
Yeah, I think what SCI did was have broader participation in testing, which is helpful, right? So one of the things that we saw was we would run quarterly market-wide circuit breaker tests, people didn't show up. Like it was the exchanges would run them, but we didn't have broad industry participation. And so we actually changed our rules to require members to show up to our market-wide circuit breaker test so that they did actually have to show up. And that's the same theme as SCI, is requiring people to test annually. I think there are some elements of SCI that are more valuable than others, but I do think having the focus on system integrity is important. I know it's important to the New York Stock Exchange, and we have it naturally because we know we need to in order to operate and maintain our systems and services. So, I think SCI is really putting that same rigor across the industry.
So let me turn now to sort of the major arcs of modern market fragmentation and then consolidation in the U.S. exchange industry. And I'm thinking about late 90s and early 2000s, and we had ECNs, we had Island against the incumbent exchanges, and then we had BATS and Direct Edge gaining significant market share later on. And, so in this era, or kind of in these, we have these cycles, and we think about market power and monopoly power. A question came up noting that Google was just sued by DOJ because of monopoly issues. Can you tell us in that backdrop a little bit about MEMX and the antecedent motivations for MEMX and their, the founder's thesis and your perspective on that thesis and how you're
maybe those aren't the same answer.
Right? Yeah, no, maybe not. And this is not meant to be an ambush of any sort. It's just.
You certainly can't call the exchanges a monopoly in any way. Look how easy it is to start an exchange. And we've seen this movie a number of times. And I've gotten that question from people who say, hey, wow, like your customers are starting an exchange to compete with you. That's unprecedented. And I'm like, what's unprecedented about that? Like I have this movie on autoplay, right? I mean, we've seen it a number of times. And frankly, the New York Stock Exchange was member owned. Like, we should not forget our history, right? I mean, it was owned by the members. The members monetized it and sold it, and then decided they wanted to go out and have another exchange and monetized it and sold it, decided they wanted to have another exchange. And so this keeps replaying. And there are different drivers for why they want to do it. But frankly, I think they think there's a profit opportunity in starting an exchange and selling it off. So that's not new. What MEMX would tell you is that they're going to do it cheaper than other exchanges, that they're going to have a lower cost and better technology. They've yet to prove themselves on the better technology front, but the lower cost, I mean, our all-in cost to trade is roughly 5 mils per share. That includes trading on the New York Stock, on our exchanges, market data, co-location, all the connectivity, everything you pay us, sort of depending on market conditions, between 5 and 7 mils per share. That is less than it costs to trade on a dark pool. That is less than it costs to trade on a number of venues out in the US markets. So I think it's really false to indicate that we are, that there's been some sort of monopolistic power that we've often heard described of us, right? Especially with market data. Now, those economics have shifted for customers, where it used to be that the transaction costs were a little bit higher and fixed costs were lower. And now that dynamic with competition, as competition does, it increases fixed costs and lowers variable costs. So our market data and connectivity costs for brokers are much higher because they're paying to connect to a number of different venues. They're paying to stitch the market back together and see a consolidated quote. They didn't used to have to do that. They didn't used to need to do that across so many venues. But the trading costs have become much, much better and much lower. Those get passed back to the customer in many cases. So the dynamics have shifted, and that Wall Street's now picking up more of the bill that used to go to their customer. The retail investor has it better than they've ever had it before because they're getting better prices and they're getting the benefit of lower transaction costs, and which ultimately led to free commissions. So it's a very good environment to be an investor in. But the dynamics for Wall Street firms and broker-dealers has certainly changed. It's not too dissimilar from what we're seeing across other industries. As a personal consumer of data, across my phone, across platforms, I now subscribe to Netflix and Hulu and HBO, and like I have a whole plethora of content that I'm subscribing to. I don't have to, but if I want all of the different shows that are out there, I might choose to. And that's not very different from what brokers are doing. If they want to see the prices on every single venue, they can get them from the SIP, or they can subscribe to the exchanges directly. And that's really turned into a fight about market data in many cases, which has been the founding thesis that we hear from MEMX a lot, is that, hey, we're going to approach this differently.
Yeah, I mean, speaking of Netflix and Barry McCarthy, right? I mean,
oh yeah,
maybe you can get some good advice from him on what to watch.
Barry has a lot of good advice.
Yeah, so I mean, the standard mantra has been costs of connectivity and costs of data feeds. Is there anything else specific you want to say about those things?
Yeah, I mean, I think that's really reflective of the fragmentation of the market, right? So I think the underlying point here is, with so many different venues and so many different locations, your fixed costs are going to continue to rise. We're also going to see volatility with more markets, and I don't think we should minimize the impact of that, because there are so many venues that have a lot of the natural liquidity. I mean, I talked a lot about market makers. It's not that we only care about market makers. The fact of the matter is, a lot of the liquidity on exchanges today is based on market maker quoting. And a lot of that natural liquidity, which we would love to have, tends to reside in dark pools. And so that natural investor, large institutions, for a variety of reasons, they choose to trade in those ways. But when the markets get busy and they start moving, and that liquidity comes back to the exchanges, there's a very brittle top of book, which means we don't have a lot of liquidity to absorb those market moves. And so that's when investors are really starting to pay for that, because you see these massive price moves because there is very little displayed liquidity to absorb it. So I do think we should focus on fragmentation and the risk it creates in the marketplace, especially during volatile conditions.
So Kumar Venkataraman, I don't know if you know Kumar, he's got a question. It's about whether the market structure works well for less actively traded stocks. Does fragmentation make it particularly challenging to find the other side? And he has.
Yeah, I mean, it doesn't work great for less active names. It never has. I mean, I've been in this business for 25 years. The less active names have always been hard to trade. There's always been less liquidity. If you now talk about spreading that out, does it make it even harder? Yes. I mean, there have been some proposals around centralizing that liquidity. Some of the versions that we've seen that we haven't supported are ones that talk about centralizing exchange liquidity, but not addressing the off-exchange liquidity. And that I think doesn't actually solve the problem, because in those names, most of the trading happens off exchange with only a small subset on exchange. And and that subset is primarily the primary exchange. So if we were going to address just 10% of the market, we're not going to solve that problem. If you really wanted to centralize liquidity, having all trading in one place, off exchange and on exchange, with exemptions for block size trades or price improvement, that might actually be a helpful change, but that hasn't been proposed in that format.
And so I think that was part of the motivation for Kumar's question in the first place. Are there ideas to improve the one size fits all sort of structure?
Yeah, I think another area where one size fits all doesn't necessarily make sense is the tick size. So under Reg NMS, we've put all stocks, regardless of market cap and volume prices, into penny ticks, everything over $1. And that I think doesn't necessarily make sense. And I think that could also help liquidity profiles. If you start looking at in the very high price names, does it make sense for them to trade in pennies? And in the lower price names, is a penny the right tick on that front too? And so I think some evolution there would make sense and would provide a little bit more liquidity. And the disparity between on exchanges and off exchanges trading tick access. So exchanges are sort of forced to the penny and midpoint, but there's a lot more flexibility on other venues for various ticks. So harmonizing that, I think, would also address some of the concerns there are around displayed prices and the benefits. If you're displaying your price on an exchange, you're taking more risk than anybody else that isn't in the market. There should be a reward for that or some incentive to do that. And so I just don't think we can lose sight of that. We're forced to use rebates to incentivize that behavior today. I'd love to have other ways to do it, but that's really the only tool we have, which is why we've been very vocal in protecting it. And which is why I sued my regulator. I mean, like, I definitely don't want to do that. I never want to, the SEC has been very constructive and helpful on so many fronts. And so when we challenged the transaction fee pilot, we didn't do it lightly, but we feel strongly that we need to make sure our markets are resilient in volatile conditions as well. And it's the only tool we really have to incentivize that behavior.
Yeah, I think Amy Edwards from the SEC again is posing another question, and she's wondering about designated market makers. And with 4 firms now acting as designated market makers, is the NYSE thinking about the potential impact of the announced acquisition of one of those DMMs by Citadel? And could that have, what impact might you speculate about the trading environment?
Yeah, the NYSE reviews every DMM transaction combination, whether it's a sale or a merger. And so we have not yet received materials to review this one that was announced. We've seen the announcement for sure. We will review it as we review all of them. Certainly, we are we feel strongly and recognize the value of the DMM that it provides to our listed companies and their investors, right? So it leads to better outcomes for companies. Their stocks trade with less volatility. They have tighter bid-ask spreads. It reduces their cost of capital, not just to ensure flawless execution around an IPO or any complex transaction, but every single day around the opening closing auction. On March 20th, when President Trump announced at 3:59 p.m. that he was going to have the oil reserves filled, there were a number of oil stocks that received massive influx of buy orders. And there was no price anywhere where that sell interest was going to be enough to offset that demand. Or in some cases, these stocks would close up 700%. But the fact was that because it was so close to 4 o'clock, sellers could not enter orders. So they would have closed up 700%, in some cases. The human being, the DMM, said, well, this doesn't make sense. This isn't the right price for this stock to close. And if the market had access, it wouldn't. So we have a rule that allows the DMM to request to delay the closing auction and receive incoming offsetting interest. And we did that, applying human judgment, closing those stocks in line, just up a few percentage points. And those trades stood as genuine closing prices. That value that we can provide as an insurance function is really critical to issuers so that they're not having their closing auctions, potentially busted as erroneous trades. It could have been a quarter end or any other market event. So having that human judgment is really important. We'll review it. Now, there are some changes that we've seen over the past several years with respect to NYSE's technology. So as we saw in March, we can completely operate electronically. We're not dependent on the DMMs for our markets to function. They're an added value. And so we're committed to that value, but we can certainly run, we run 5 equity markets. Only one of them has a human designated market maker at this point in time.
So this is a question from the audience that's a little away from sort of this high resolution focus on what you do in terms of price discovery and trading. The question is about, are the markets in this particular environment, the pandemic, departing from, fundamental values? So this is really kind of an opinion. I saw something from Tim Collar at McKinsey the other day arguing that no, in fact, the markets are reflecting fundamentals and there's not a disconnect between Main Street and Wall Street. But and you can fend me off if you want.
I'll give you my opinion on this, and I think it's confusing for a lot of people because you look around and you see family members and friends and so many businesses struggling and markets at all-time highs, and it just doesn't compute. It just doesn't make sense. I think it's important for us to recognize a couple of things, though. One, the market is not reflective of our overall economy. It's reflective of our public companies and how they're performing and what their forward-looking, what their forward opportunities are. So the fact that the market is forward-looking is also an important aspect of this conversation. That if you're thinking, if there is a vaccine and we've made tremendous progress on a vaccine, unprecedented progress on a vaccine, if there's a vaccine and we believe the economy will recover quickly, and that these companies will recover quickly, then that's an optimistic viewpoint that can be expressed in the market. So forward looking is one element of it. The fact is it's not, even if you look at the companies that make up our public markets, a subset of them are making up the indexes that are being used to describe market performance. And in those indexes, a subset of them are overweighted. And so if you're talking about 5 tech companies making up 20% of the S&P 500, and then using the S&P 500 as a proxy for our economy or the state of Main Street, I just think that you're not going to get a one-for-one comparison there. It's not accurate. If you start to really dig into what we're seeing in the public markets, not all businesses are impacted the same. Many industries have had a very challenging year. Their stock prices reflect the challenges they've been faced with. And then there are industries that have had a good year, and who've actually had their businesses have been buoyed by the pandemic. And technology happens to be one of those industries that's generally done very well. So I think that it's important when we talk about Wall Street and Main Street and the market and our economy, they're not all one for one. Even looking at the index, so I've just said that, hey, not all companies are reflected equally in that index. Not all companies are public. So restaurants and a lot of the small businesses that are most dramatically impacted right now aren't reflected in the S&P 500. So I think it's not so much that it's broken, it's just being described, it's being used to describe our economy more broadly at times that I think perhaps doesn't make sense.
So I just want to circle back maybe with one last question. And you've already spoken a little bit to the situation where you have maybe 40 or more trading venues. We've got lots of dark pools, and you've seen migration. We have fragmentation, but we have seen, you're describing migration from dark pools to your venue. So the question is, how does NYSE compete with dark pools on the edges? What's the market impact of a trade of around 10% average daily trading volume in a single day? And the question is a little more detailed. It asks, is it around 30 BP on NYSE, yet 50 or 5 on dark pools? So does that make sense?
I didn't follow the question entirely.
Yeah, let me try it again. So what's the market impact of a trade of around 10% average daily trading volume in a single day? Is it around 30 basis points on NYSE at 5 basis points on dark pools? And how does NYSE compete with dark pools on these edges? Is that help?
I'm not sure I totally understand the question. I'm not sure if you're talking about the cost of trading on the venues or.
I think yeah. So they're talking about relative costs. And you've already said that we have
we're
migration.
Actually cheaper than most dark pools with respect to costs. And maybe they're talking about sort of market impact on.
Yeah, so price impact maybe.
Yeah, price impact sort of following the execution. And so it certainly varies. Even on exchanges, it varies based on which exchange you're trading on, right? And so there are a number of exchanges that have different pricing mechanisms in place that also have an impact on sort of the price impact coming out of that. Part of that is driven by our lack of flexibility in the regulatory regime to treat customers differently. So very easy for a dark pool to give different economics to certain customers. We've talked a lot about the fact that, there's a lot of interest in trading more against retail flow. And there's a good reason for that. Retail flow tends to have a longer time horizon. So they're not looking at every single tick in the E-minis and deciding that, they have more information than you. And so it becomes a lower risk trade to trade against retail. We can't treat people differently on the exchanges. So we sometimes try to attract different customers with different pricing mechanisms. I do think some of the proposals we've made around reducing the transaction fee structure in the US without running a pilot, but just reducing the overall cost would reduce some of those different pricing mechanisms, both on exchange and off exchange. Perhaps encourage some off-exchange trading that's just price sensitive to trade more on exchanges, and then reduce some of that overall fragmentation. So we propose that as an alternative to the SEC. And we're hopeful that we'll start to see some steps taken to reduce fragmentation in the market, though.
Stacey, we're about out of time, and while the audience has appeared before our gates with pitchforks and burning torches with long lists of questions. Instead, I'd like to invite you, if you have any last thoughts or comments before we proceed with the ceremony.
Well, I just to say thank you for having me. And I think we've been tested this year pretty significantly as a society, as people, as an industry. And we need to, continue to share the same focus. I think we're all doing our best to get through this period of time. And I think it brings out, crisis very often brings out the best in who we are. And I think that's a good thing. So what did we learn from this? And what can we take away from this experience this year to really think about how we want to transform our businesses and our lives going forward? And that's the kind of thing we're spending a lot of time on, and our customers are too.
That's wonderfully optimistic, and it's a pep talk for those of us who are living in our dungeons.
Yes.
Around the country.
So is no joke this year.
Yeah, it's horrible. All right. So Stacey, I was, in terms of the award, I think we were going to get you a bell as a physical manifestation, but maybe you've got one, or NYSE does. So we'll probably pass on that. I don't think anything really could compare either physically or symbolically to a specific Leroy Neiman painting of the NYSE floor. And I'll tell our group that was a gift to you from your father, I believe. But what I can offer is most sincere professional and personal thanks to you for the gift today of your time and perspective and expertise. And I think likewise the appreciation of a large association of experts in finance. So it's a great pleasure, Rena, the two of us, I think, to convey to you on the 50th anniversary of the founding of the association, the designation of FMA 2020 Outstanding Financial Executive. And I'd ask our group in whatever way it's possible to join me in congratulating Ms. Cunningham and also to thank her for, again, her expertise and time. Thanks, Stacey.
Thank you so much. I really very much appreciate it.
It was a real pleasure. Thanks.